All right, so the tokenization of real estate, right? So I think before we even get into that, right, real estate can mean many, many things, right? So real estate, I think people think of a house, right? So multiple classes of real estate. And we deal with real estate from single family properties through large office building, through car washes, gas stations. Real estate can even be other alternative assets you might not think about. As well. So real estate is a very wide ranging topic, but it's one of the best asset classes to invest in. So the tokenization of real estate is going to be the process of creating a virtual token that represents your ownership in this real asset, right? So a token is going to represent your actual ownership in a building, a fraction of one building, or in maybe an entire property. So that's the basic of what the tokenization actually is.
Yeah, and then the next thing is like why? Like why are we talking about this? Why is it important? Why is it even interesting? And I think it's exactly what it says here, right? We're allowing for investment in asset-backed tokens that are pegged to the performance of a physical asset versus kind of your volatile cryptocurrencies. And I think what we're really like driving at or drilling into in this presentation is how are we like marrying the two kind of markets? We're leveraging the benefits and the efficiencies of the blockchain and technology in order to tap into real estate, right? And you'll see that the vast majority of like the principles that we go over today are rooted in real estate concepts that have been around for a very long time. So there's a couple of use cases, and we're really going to be mostly centered around that first one that's in bold. So the equity ownership in a legal entity. So that's kind of like the biggest, like probably most relevant use case in today's real estate world. Um, you'll also read about like the actual direct ownership in a deed, which could be a use case more down the road as kind of technology develops and at like various local levels. Ownership of collateralized debt is kind of another potential use case, but we will be kind of focusing on today, at least for our examples, the equity ownership in a legal entity, and I know obviously the community is probably well versed in kind of the foundation of this type of thing, but this is not the purchase of real estate and like in the metaverse. This is true ownership, physical real estate, right? True ownership of an entity that owns real estate, a physical asset here.
Wonderful. So we'll start talking about some of the pros, right? So the pros to the tokenization of real estate. So number one, investor access, right? So as an investor into any asset class, especially real estate, right, having access is key. So this would allow for theoretically, and it does exist today, a secondary market, right? So when we talk about a secondary market, oftentimes if you invest in a private placement real estate deal, so you invest as a limited partner somewhere in your friend's multifamily project, it's very, very difficult to exit that position, right? You're going to have to work with the overall general partner to get out of that. So this would allow for a secondary market to be created to trade on these private tokens. So accessible secondary markets for buying and selling of tokens. Um, and then you would be able to hypothetically have a fractional interest in a project at a lower entry point, right? So you may not need to drop $100,000 to enter a real estate project. It could be better access. We're going to talk about some of the caveats to that in just a few moments. And then capital access, right? So this is more from now the syndicator, owner, or general partner side of the real estate deal. You're going to have a more global investment market because oftentimes syndicators don't want to raise money from outside the U.S. So foreign capital for various reasons. This is going to make it a little bit easier. You're going to have more liquidity options, right, to raise money to mitigate interest rates. So obviously, real estate debt financing is huge. There might be an additional way here to raise money quickly using the token method versus traditional lending practices. And obviously, oftentimes with more nuanced real estate, take something like a short-term rental. The banks are going to underwrite the property in a certain way, and there's sometimes what we call a gap. So a gap between the appraisal and the loan amount. You have to come out of pocket for that. So this might be a way to close that gap pretty quickly by issuing tokens and having investors come in, get some skin in the game relatively quickly. And obviously, with smart contracts, it could be pretty seamless. So these are some of the initial pros here.
And oh, go ahead, Greg.
Yep. So just some additional pros here. So the efficiency and the transparency. So obviously, hypothetically speaking, right, there's going to be lower costs at all levels. Using tokens is going to overall lower the amount of we'll call service providers that are involved in the deal, right? So think title insurance, think all of the closing attorneys, think of all these parties that are involved just when you're buying a primary residence, right? There's a lot of people involved in that transaction and they're nickel and diming fees left and right. Now, take that to a 20-story building. There's a lot of costs involved for kind of this back office type of work that's getting done. It's very necessary today, but again, by having smart contracts and doing this via tokenization, those hypothetically could go away or be really reduced. And obviously, the contractual friction. So we talk about counterparty risk that could be really decreased here through this method. Liquidity wise, right? So we kind of talked about this a little bit, but liquidity would be a lot more straightforward. Distribution. So we'll talk about distributions when we get to the tax section with limited partners would be easier here, right? So anyone that's ever worked on the fund side of real estate, so like for the general partner of the fund, the distribution process can be quite difficult sometimes for various reasons. Sometimes it's simply tracking down the investors. So liquidity would be easier. And then the next pro here, transparency. So obviously there's a security aspect to this by having these transactions on the blockchain, and there's undeniable proof of your ownership in this. And if you're not in the real estate world, you look up the term title swapping or title theft. There are cases out there, where we've had investors in single family markets, maybe in certain parts of the country, where they have eyes off their property. Someone can literally steal their title, right? And there's sophisticated ways people are doing this. And it's very, very difficult at that point to prove your ownership when the title gets stolen. So it's a real risk. It sounds like how could that ever happen? But it does happen a lot in the real estate world, especially with small investors, small single family properties. So obviously the undeniable proof of ownership here would make that a lot easier. All right. Last but not least, on the pros side here, so real estate tax benefits, right? So at the end of the day, when you're tokenizing real estate, it's still real estate, right? And we're going to get to the tax piece of this in a minute, but it's still real estate, and you're going to have great tax benefits. So we always say if you're not a real estate investor right now, the four keys to real estate, these are our keys to real estate. So appreciation, meaning real estate historically does appreciate. It's going to go up about 7% per year, right? There's troughs, there's highs and lows. Number two, it's going to depreciate for tax purposes. You're going to write the cost of the asset off over time. Sometimes you can use that, sometimes you can't, but it's still going to reduce your income. Number three, the tenant's going to pay your mortgage, so someone else is paying the bank. And then lastly, the net cash flow that you receive from the real estate project or property is likely going to be completely tax free because of some of these other benefits, right? So real estate has great tax benefits. Tokenization of real estate is just an entry point into these benefits, right? So at the end of the day, the underlying investment remains real estate. The underlying tax benefits remain real estate, which are some of the best benefits from a tax perspective. And we'll go into that in just a little bit.
All right. Well, with the pros, there are always cons. So here are some barriers to the tokenization of real estate. So vendor complexity, there's just limited options out there, right? So limited supply is going to be higher cost associated with kind of the various parties that need to be involved, whether it's legal, whether it's administration, management, what have you, right? It's not a mainstream thing yet. So, and that kind of is the same thing with the investors, right? There's low level awareness among investors, right? It's not mainstream. So it's not quite there yet. SEC compliance. These are investments, right? So they can be considered securities. So there's SEC compliance that needs to be had there, which I'm going to kind of touch on a bit in a moment. Overall, the legislative framework is like fairly weak, right? So the digital asset space and then the local real estate systems are pretty archaic in comparison to a lot of the technologies that we do have. So that's something that needs to be kind of contended with. Tracking of performance in the secondary market, right? The private valuing of tokens is something that we'll talk about a little bit more. And then Greg's going to get into, partnership tax, right? With fractionalized ownership, there's additional reporting, especially if foreign investors are involved, which is a big difference. So that's something we'll talk about a bit more as well.
And I think I would emphasize on this slide as well, John, is like and we kind of talked about the title theft, right? So the local real estate systems can be a barrier here because they are very archaic. And anyone's done deals, especially in smaller communities, you're sometimes beholden to extremely paper-based system, right? Not even digital at all. So there are going to be those issues to deal with, and hopefully over time that stuff improves. But in today's environment, there's a lot of markets out there that simply don't have good, aren't set up digitally at all. So there's going to be issues around that for sure.
Yeah, totally. And then kind of getting started, like I just wanted to set the stage as to like what this all would really kind of look like in that first example that I went over, right? A equity ownership in an LLC, so a syndication project, right? So you have here like a sponsor or an issuer of the who an issuer in a syndication, also known as a sponsor in most cases, would be utilizing the blockchain to issue these security tokens. So rather than paper contracts, if you've been involved in these types of deals, there's a lot of operating agreements that are extremely complex. There's a lot of paperwork to determine ownership. And really, at the end of the day, your ownership in an LLC, in a syndication, or in any type of partnership, even if it's small or big, is really just relegated to a piece of paper that people sign, right? That is stored in a, on the cloud or in a file cabinet. So there's a lot of efficiencies to be gained there, right? So on the on the right side is a very high level look at like what a setup would look like. So in the square is kind of your real estate asset, whatever it might be, that's owned by an LLC. A lot of people use the term SPV, or special purpose vehicle, that owns title to the real estate. That SPV is governed by a smart contract, right? And the security tokens are issued therefrom. A private placement memorandum, if this is something that's being offered to the public as a security, there needs to be a private placement memorandum, which is something I'll chat about a little bit more in a moment. Um, and then, a kind of a misnomer is that like the tokenization is like completely democratizing real estate investment. And in most cases, because of the regulations I'm going to go over, it really doesn't, right? You still need to be an accredited investor in most cases, right? So someone that is not meeting that level of accreditation, um, still can invest in some of these types of deals, right? And it's not a very high barrier, but it isn't something where kind of everybody can kind of get involved in. So, and I'm going to go over that compliance next.
Yep, and then just if people aren't familiar with an accredited investor, I think our slide got cut off here, but it's $1 million net worth, excluding private residence, and then individually $200,000 of AGI, or I think it's 300 if you're married. So again, that is still a barrier, right? So I think that there is talk about loosening those rules, and there potentially might be a test people could take, because they are kind of silly and they don't even index the numbers. So that is still a barrier today. So someone making $40,000 is still not going to be able to get into these deals, for the most part of how they're structured.
Yeah, and kind of getting into like the SEC compliance, I think it's just important to have a primer here. Obviously, this isn't an SEC or a regulations um, CPE, but I think it's just good to kind of underpin some of the traps for the unwary here. So it is a security. So security, very simply, is an investment of money in a common enterprise with a reasonable expectation of profit to be derived from the efforts of another, right? So it's not your personal effort. You're relying on the efforts of another. That's what makes it a security. So tokens in this context can be considered a security. And in the example that I'm using, um, almost nearly most all circumstances are going to be a security. So to avoid registration with the SEC, the issuers of these tokens will have to comply with one of the exemptions, right? So when I say register with the SEC, that's like a public offering, like an initial public offering, an IPO. So then there's these carve out exemptions that exist that are kind of streamlined ways to comply, and also be able to issue tokens in this context. The most common one that you hear is reg. It's what's known as reg D, right? People talk about that quite a bit. It's definitely the most common exemption for real estate syndicators. And 506C is the actual code section, and that allows you really kind of these 4 or 5 points really capture it. So you can raise an unlimited amount of money, so an unlimited amount of tokens. There's an unlimited amount of verified accredited investors, so they have to be accredited investors. You can advertise. You have to file this Form D. and it preempts anything that's at the state. So there's just one filing at the federal level, and that allows you to kind of do this in a widespread manner. So that's kind of like the main one that you're going to see. Other ones,
And John,
in
John, just to stop there for a second. So on the Reg D, if you're raising through Reg D, does the underlying investor giving the money, unlimited money? So if they're not accredited, is there any way around that for them to get into this?
So if they're not, there are other exemptions that allow for unaccredited investors in a limited fashion. So um, it would just be just a matter of applying under another exemption. I'm only using that particular one as just illustrating kind of the most common way to do it.
Understood. Okay.
So other exemptions, so you hear about crowdfunding. So that could be something that is would definitely apply to the tokenization of real estate, right? It's just smaller amounts because it's going to be smaller. It's going to be smaller amount of investment. So you do 1 million in 12 months. That's the limit. It's a specified project, so no blind pools, meaning there's a fund for a specified real estate asset, specified project. It's not just this open-ended, hey, we're going to raise this capital and invest in multiple projects. You can have an unlimited amount of investors. So no pre-qualification, so no accreditation requirement on investments under $2,000. There is more requirements if the investment is over that. And then it has to be through one of these broker dealer platforms or funding portals that you kind of see online that are there.
So on that one, John, so the crowdfunding, so people that are trying to raise money through social media, is this what they're trying to do?
I think it depends. I think that people in social media can still use the 506C that I just went through, right? They just have filed that Form D, right? Because there's advertising a lot in that context. I think crowdfunding is also an option in that context, but it needs to be through one of those platforms. So they need to be set up through one of those platforms.
Okay.
And then Regulation X is completely offshore. So this is going to be it's not always something that comes up in the real estate world, but obviously with kind of the the digital market being so vast, it's definitely more prevalent. So unlimited raise amount and number of investors, but they have to be offshore. And there's limited disclosure and SEC filing requirements, and there's advertising allowed. So this is just basically saying that if people are offshore, that the requirements are less. And then the other thing that you kind of always hear in this is like family and friends. Like if I'm just doing in family and friends, that's not really an exemption. That's not something that is codified in any way. It's still a security in the eyes of the SEC. So while you kind of have an understanding probably with those people, it's not something that is a real exemption.
So I think practically speaking, what we see in practice a lot is that the last one here, family and friends, it's not an exemption. I think people, especially that's why I brought the social media in this social media world, people have definitely exploited the fact that they're claiming that their friends are on social media, so they're raising through social media, and they're saying it's family and friends. It's just a partnership. We're not actually raising money in a public offering. So you know, I think people have to toe the line with that. Because remember, if you're offering a token in this case, if you're raising funds to offer a token for a real estate project, you cannot circumvent these rules John just went through, which is unfortunate, but that's just the reality today. So if you just post on Instagram, social media, or your clients do, that's gonna cause a problem hypothetically, right? You can't do that unless you have a registration, especially the Reg D, like John showed. And John, for context, how difficult is something a Reg D to do? Can it be done DIY, or is it something you absolutely need an SEC or a syndicate lawyer to perform?
I'd always recommend a lawyer in this context, right? It like anything else, it's a filing, but there is nuance to it. I wouldn't recommend doing it without counsel.
Understood. Okay. Awesome. All right. So some of these barriers to entry we talked about from the SEC side of things as it stands today for these securities. We'll go into some of the tax items here next. All right. So theoretically speaking, right, there's multiple different ways that a token offering could participate in real estate. So we're going to focus on mainly equity, the equity side of this, but there's other ways we'll talk about as well. Remember, the underlying transaction will always specify the U.S. income tax treatment in the Internal Revenue Code, right? So no matter what we layer around it, the underlying asset, the underlying investment will dictate our tax treatment. So there are no special regulations on this from an income tax perspective right now, and I know people will talk about that this week. So we have to keep that in mind as we go through this. Now, as we mentioned at the beginning, if you were to raise or if there's equity tokens, they're going to represent the ownership shares in a real asset or the LLC that owns that project, right? So the project LLC that owns the real estate. Think of this as similar to a direct limited partner investment into a real estate project. So over time, right, you're going to receive cash distributions, and ultimately you, or in this case, the token, is tied to the performance of the asset or assets. Now, within the equity section, right, there's three different ways we see this. Number one, direct ownership token, meaning, hey, there's a token being offered for a direct stake. Maybe it's a 1/3 stake of that triple family down the street, right? It's a direct ownership in one project, which is owned usually by one limited liability company. Very, very straightforward in that sense. Number two, a fund token, meaning this would be similar to a REIT, so a real estate investment trust, which is a public security that's out in the market. So if you wanted to diversify several different projects, several different buildings, whatever the asset class may be inside of that fund, that would be what you're doing there. Again, this is a little bit more complex. And then a preferred equity token, right? So we've seen this where in real estate, you'll hear the word PREF or the term PREF, so a preferred return, where these token holders with the PREF tokens would receive their hypothetical stated return on investment first before the other classes of equity, right? So every dollar out has to get up to their hurdle, their preferred, their prep, as you call it, before the other equity holders are ultimately paid. And there's a million ways to legally structure that, but these are different equity ownership structures that could work in the token world. So on the other side of the aisle here, you could also have debt. So we've seen this, and this is we're not going to focus a ton on this today, but this is a lot more straightforward. So a debt token, hypothetically, would be similar to if anyone here has done hard money lending or you're just giving cash to a project syndicate or giving cash to a friend or family member, right? That's going to perform some type of real estate project. So the debt is tied to the underlying real estate asset again through this token. The investor of this token, in this case, would receive interest payments, and obviously they would pay the principal at the maturity of the note. The big difference here is though you're not an equity investor in the project, you're not technically tied to the performance of the project, so your tax implications are a lot different here and a lot simpler. So you're gonna have no K1 reporting. You will have 1099s, but it's less complex from both the investor and the general partner or syndicate's perspective. Now, um, logically speaking, I'm not sure. There might be some funds that are set up as debt funds. There's a lot of debt funds out there where this would be useful. I don't see people at this point using tokens for debt on small projects because it's usually a lower barrier to entry. A lot of this stuff is done with I mean, not saying it's the right thing to do, but a lot of people have very, very straightforward, simple agreements with people in the hard money lending world. So I'm not sure how this would catch on simple projects, but for the fun perspective, it's definitely something that could have a pretty good use case down the line. All right, so let's talk more in depth about the tax implications for the equity side, right? So the equity-based tokens, again, equity represents the direct ownership in the underlying asset or the LLC that owns such asset. So how we see this generally speaking, right, is that one LLC will own one asset. That's not a hard and fast rule. One LLC could own multiple assets. That's a risk profile. It usually depends on how much debt you have in the project and how much you're at risk for. But to keep it easy, right, one asset goes into one LLC in our examples here. So your ownership, right? So when if someone's offering a token to you as an investor to get into one of these projects, obviously your ownership stake's going to be it's going to be based on the number of tokens that are offered and sold divided by the total cost of all minted tokens for the investment. So I think that what we've also seen here would be a little bit tricky is let's just say there's 10,000 tokens offered and you like I got 5,000 of them, great. I own 50%. Not necessarily. A lot of these guys are using other types of bridge financing. They have multiple streams of equity ownership coming in. There might have just straight investors, right? So be careful of doing the simple math and figuring out how much you own because you might be disappointed. That's a little bit lower. And we'll talk about how to read the operating agreement in a few moments. So the most important thing from the investor's perspective, we think, is understanding, especially if you're using the tokenization to get into real estate for the first time, understanding what your capital contribution actually is, which is going to be very important for you from a tax perspective. So in this case, you're going to figure it out by the number of tokens you hold multiplied by the dollar value, right, of the offering of the token. So let's just say there's 1,000 tokens at $50 per token. Your capital contribution in this project is $50,000, which would also be equal to your initial what's called tax basis, right? The skin in the game that you have. Now, be aware, right? So, practically speaking, a lot of people that are going to do this are going to be exchanging other crypto to buy the tokens. Obviously, you got to consider the implications of that. And then any type of fees that you have to transact to invest in this project likely will be added to your basis in the project as well. So, coming in, right, it's not too complex. You just got to understand, hey, what is my skin in the game here to start from a tax perspective? That's going to be very important down the line when you end up coming back out of this. Or number two, the secondary transactions. If you end up trading this on the market, on a secondary market, you're going to need to understand your capital contribution, your basis to figure out how much tax you're paying if you do leave. Okay, so the next couple of things here, right? Just now we're into the project. We've bought in the $50,000 of tokens. We're great. We can prove our ownership. Everything's hunky dory. Now, what happens after that, right? So, as we said at the beginning, people have different perspectives on real estate, but it is one of the most efficient asset classes from a tax perspective. The U.S. government has incentivized real estate since the beginning of time, and they continue to do it no matter what administration is in charge. They just switch the type of theories. So right now, real estate syndicators are very much focused on doing energy efficient improvements, and they're getting very large tax benefits called 45L 179D that are flowing out to their investors, right? They're renovating historical buildings and bringing them up to code. They're getting tax credits for that. So real estate has so many elements to it. They're tax efficient, and you want to share in those benefits. So you as a member, right? We're talking on the investor side as a member, you're allocated income according to your percentage owned in the LLC at the most basic level, right? There's different waterfall methods we hear about, but to keep it simple, you're allocated um, based on your ownership in the LLC. So it's going to be the rent received by the overall project syndicator, less all operating expenses, less depreciation, right? So the writing off of the property over time, very simply stated, 27 and a half residential, 39 years commercial, less interest on all of the debt, and then obviously multiply that by your ownership unit. That's going to be what your income allocated is. Now, here's a really important concept for real estate if you're entering this way. Cash distribution, right? So the syndicator sends you in March $2,000 check. That is not in itself directly taxable, right? So members are ultimately taxed on their allocated share of income, whether or not the cash is distributed. So real estate has what's called phantom income. This can sometimes catch first time investors by surprise. They'll say, hey, my accountant or TurboTax or whatever is telling me that I owe $800 on this real estate fund. I didn't get a dollar. It's because they're allocating you income and they chose not to distribute cash, which is their right in the operating agreement. So be careful of that. However, most times it does not happen because there's adequate depreciation and other tax benefits to wipe all the income out. But just be aware of that. There's other times where you might get a cash distribution, so you have money in your pocket, but then your K1, the tax document you receive, has a negative number on it, right? So in that case, you received money, but you're not paying taxes, right? So it's not like you're skirting the rules. It's all a timing mechanism. So you have to understand how real estate works from a partnership perspective to not get caught off guard by these things and make sure you're aware of the concept of phantom income, how that could potentially occur. Okay. So we talked about a little bit before on the debt side, right? So you are as an equity holder, you're also going to be allocated debt within the partnership. That's not debt you gave. We're talking about bank financing. We're talking about the loan on the building, the loan on the asset. Now, I can't stress enough how important this concept is if you're a limited partner or you're advising someone that's a limited partner, because we've seen hundreds of operating agreements over time. They're all different. Some of them are just printed offline, some of them are terrible. And you have to understand how this works, because if there is ever a dispute, you're going to have to go back to this operating agreement, and that withholds all the weight in the law. So inside of an operating agreement, the binding terms that you're agreeing to here, you want to check out if you as a limited partner investor via the tokens, are you being allocated what's called qualified non-recourse debt, QNR debt? That is basically the debt from mortgage. If you're not being allocated that debt, you may not be allocated all of the losses you deserve, or if you are allocated those losses, there might be what's called basis issues that come into play, causing unnecessary capital gains to you down the line. Confusing, right? So oftentimes, first time syndicate members, they get this operating agreement and they scroll through DocuSign, they sign it within a minute 45, right? Pretty typical, but it's not always the syndicator that's trying to skirt the system here. Sometimes it's just mistakes. So you got to be aware of this. You want to make sure that you have adequate debt allocation. This doesn't mean that you're on the hook if everything goes wrong. You're on the hook up to your investment is, but you're not going to be on the hook if the property goes bankrupt, the whole thing. So you want to be allocated debt in proration to what you've invested. So be very careful of that in there. Number two, we always say review what's called a special allocation. So this is something that syndicators do. Oftentimes, the sophisticated syndicators will do this, and there's nothing wrong with it technically. But what they're going to do is they're going to um, allocate special items in the operating income to them. In other words, the depreciation may not be allocated pro rata. They may say, "Hey, we're going to actually we own 20%, the investors own 80% through their tokens. We're actually going to take 80% of the depreciation and give them 20, right? So they're going to flip it. They can do this as long as it meets what's called substantial economic. That's a tax term. Be very careful because we have some people that invest in these projects say, look, I'm going to get tax free income. I'm not going to pay any taxes. The real estate depreciation is going to wipe it out. And then they say, wait, why am I getting taxable income? It's because the syndicator flipped it on you. So again, ask these questions or have your accountant or advise your client to ask these type of questions because it's either a mistake or there's some syndicators that simply want to do it this way and they bury it in the fine print of the project terms. All right, so let's just walk through an example here, right? How this would work for the first year. So again, I'm an investor. I purchased $50,000 of tokens through the initial token offering here. We went through the Reg D process. We crossed T's, dotted I's. I now have my smart contract owning these tokens, and it's a single real estate project. Very, very straightforward. End of the first year with depreciation, the profit and loss of the real estate asset is negative $10,000. That's allocated. The fund distributed to me $5,000. So again, I was allocated a $10,000 loss from the project, but they gave me 5,000 in cash to my bank account. You're going to pay no taxes on the 5,000 that came to you. You're going to receive something on your tax form from your accountant that looks like this: beginning tax capital, nothing. I bought in right through the token offering $50,000. We lost $10,000 because of our best friend depreciation this year, right? We didn't really lose 10,000. The government helped us lose 10,000, and then we were distributed 5,000 of cash as well. So then we're going to have that's actually there's a math error there, should say 35,000. So then we're going to have an ending tax capital account. So you always got to maintain your capital account. It will be on your tax forms, but you need to maintain it on your own as well. Oftentimes people switch accounts, they switch tax softwares, they lose this. So it's very, very important down the line. So you're getting these at this point, right? You've entered through the token, you have ownership to prove through the token, but it's just real estate in the middle, right? So we always say like the beginning and the end with the tokens is very, very important. In the middle, it's real estate, right? It's going to be operating like real estate, tax benefits like real estate. So the K1s are going to come out. The K1 is basically the partnership distributing the income or loss to you every year. You should see something in box two, right? Box two, which is rental real estate income or loss. Make sure it's in box two. If it's in box one, it's wrong, unless you're flipping projects, but box two. And there's no self-employment tax, right? So real estate is very efficient, not only because you can offset it very easily. At the end of the day, it's ordinary income and it's not subject to self-employment taxes like a business would be. So, or W 2. So you're going to get the K1. Most investors in these projects, right? The person that's buying $1,000 worth of tokens, most likely they're going to be considered what's called a passive investor, right? So passive within the tax code, unless they're a real estate professional with definition of the tax code and they materially participate in this venture. It's going to be passive. And what does that mean in like English? It means that if you as an investor or your client as an investor gets a nice K1 with a juicy $50,000 negative number in box two, that ain't going to go offset their crypto income. It's not going to go offset their W-2 income because they're a passive investor. It doesn't mean they lose it. It just becomes an asset in the future that they're going to carry forward. So be careful with that. Again, unfortunately, there are syndicators out there, especially in the social media world, that really drives us insane, where they'll sell the tax benefits to unwilling participants saying, hey, you're going to get great tax losses this year. And they invest, and then they're very disappointed when they find out that their $50,000 loss simply goes on to a form and carries forward, unless they have other passive income as well. So strategically, what we advise our clients say, hey, look, if you know you're gonna have a $20,000 loss from real estate, that's awesome, right? Let's play with that during the year. Go find what we call a pig, so a passive income generator. Find another investment during the year that's going to generate passive income. Now, passive income is not what we always think passive income is. It's in the tax code, passive income. So think business income in which you don't materially participate, certain other types of ordinary income in which you're not in the trade of business of generating that would be considered passive income. There are some types of passive income potentially in the crypto world that could work here, right? So if you're going to get a real estate loss, don't let it sit on your tax return. If you let it sit on your tax return, we've seen people come into us with millions of dollars of accrued losses from real estate that they had no idea was there. And the government will not index that number for inflation. If it says 2 million today, 150 years from now, it's going to say 2 million, right? So erosion from inflation. So make sure we're advising or we're taking into consideration, can we find other income that's considered passive to offset this, right? It's a beautiful strategy. We call it a lazy 1031, right? So like you're flipping things in and out of each other and just finding things you can net together over time. So be careful of that and don't get fooled on the way into these projects. All right, very quickly on the debt side of this. So if you're going to invest in the debt side of this, that's great. The only thing to consider here is that the syndicator should, I say should, but it does not always send you a 1099 INT, just like Bank of America sends you, just like Coinbase could send you, right? So a 1099 INT for the interest, it's going to be ordinary income. And if you're thinking, oh, great, I'll do this and I'll offset my real estate losses, you can't do that. This is considered portfolio income, which is not the same as passive income. So you're going to get ordinary income here. There's no deductions against this income, meaning if you earn $20,000, you bought into the debt token offering here, you own these tokens, and you make $20,000 of interest income here. There's no way to offset that income with the real estate, right? So unless you're in the business of lending, there's gonna be no deductions or expenses against that. And then lastly, it is more straightforward on everyone's side of the house for tax elements. So the case can be made if you're trying to enter for the first time into a real estate project and enter in, especially through a token method. This could be an easy way in because at the end of the day, the reporting side's pretty easy and it's going to be a lot more straightforward than it is otherwise. Okay, so we'll talk now just about the syndicator side of the transaction. So if we're on the syndicator side of the transaction, whether we are the syndicator themselves, whether we are just want to learn about the syndicator side, or we're advising a syndicator, general partner, sponsor, whatever those terms are very synonymous in our world. The first thing that we always tell our new project sponsors, so we have people that say, hey, I'm going to raise a fund. Maybe I'm going to think about doing it through tokens. Maybe I'm going to go the traditional route. We always say, teach your investors the tax implication because if we're talking about democratizing the entry point to real estate through tokens, although today it's difficult because of accredited investors rules, but if we get there, I don't know if these people are going to want to get into a project that creates tax nightmares, right? So if someone buys a token for $1,000 in your project, are they really going to want to wait until September 15th, hypothetically, to get their K1 form? So you're going to want to discuss this with your syndicator and say, teach the investors, hey, you might not be able to file your taxes on TurboTax on January 29th this year. You might have to wait until the summer, right? That might turn them off from the investment, but it's better to get ahead of that. We have seen a lot of syndicators that in March, they're like, oh my gosh, my investors are freaking out. One of the tax returns gonna be ready. And then the accountant tells them September, right? So get ahead of that early. Number two here, K1 tracking. So obviously, if you're going to get into this from a token perspective, you're going to use a platform, right? There's going to be a platform to help you manage this, especially with the headaches of secondary swaps or exchanges. Remember, there's no special regulations around this. The IRS does not care about your struggles as the syndicator figuring this all out. You, as the project sponsor, the general partner, the tax matters partner on this tax return, are responsible for maintaining your list of investors, their addresses, their tax identification numbers, social security numbers, etc. For example, if John and I are in a project and I say, John, I'm tired, I'm done. Can you buy me out? And on the secondary market, he buys my tokens. The syndicator needs to figure that out. They need to know there's a secondary transaction. So a lot of them are putting language into their operating agreement that there has to be a process in which that's approved. So it's not willy nilly. You can't just go out. You could, but legally speaking, these operating agreements being set up where you can't just go post on some forum saying, "Hey, we own this great real estate token that owns 6 buildings. Who wants to buy it?" Because you're going to have to get approval through the operating agreement in the different mechanisms in there to get this done, right? So as a syndicator, you got to be careful with this because if stuff's flying around the background, it's going to be a nightmare to figure out people's basis, people's capital accounts. It can be very, very difficult to do that over time. Number two, if you have a US investor and you raised off of Reg D, US only, and the US investor says, "Oh, this is great. Tokens are easily exchangeable. I'm exchanging my token with someone in London." You have a problem. You have a problem from an SEC perspective. Now you have a problem from the tax perspective because if you have a foreign investor inside of a US partnership for tax purposes, you have to comply with Internal Revenue Code 1446. Downside of that is you as a syndicator now have to forced withholdings every quarter at 37%. Highest marginal tax rate, 37%. So every single quarter, you got to send these forms in. I think it's 8813. You got to send these forms in every single quarter to the IRS and withhold, even if you're going to have a loss for the year, withhold at the maximum rate every quarter. So can you control this? Maybe you can probably put carve outs in the operating agreement to prohibit this type of stuff. But as you can see, if you're on the syndicator side of this, you're going to make sure that you have good systems in place. If you raise money through a token offering and you let it go wild, you're going to have a nightmare. Your accountants are going to hate you for doing this kind of stuff. So be careful. Put some guardrails in place. All right, a couple other considerations here. So we talk a lot about this cool concept of being able to use, or sorry, be able to trade these tokens on a secondary market. So again, John and I are in a project, and I say, "Hey, you know what? Like, I think we should get out of it. It looks pretty good right now. Let's see if anyone wants to buy this." We go out. We have some friends like, "Hey, we'll buy it. We'll buy those tokens for you guys." Now, the problem we see with this, right? Practically speaking, does the token holder and said buyer of the token actually understand the underlying market value of the project? Real estate valuation is highly subjective, right? So, in other words, we go back to my original slide where I said, "Hey, my basis in this project is $50,000. That's my token cost." That is not what you should. That's not what you're going to sell it for, right? Because if real estate's appreciating, the value should be going up, right? So if the syndicator is putting work into the property, which they usually do, they're forcing appreciation of this property. They're lowering the cap rate. They're increasing rents. So obviously the value is getting jacked up. Both sides could get screwed in that transaction, right? If you don't understand what the value is and they don't understand, it's going to be a problem. So, how do we actually know what my 1/10 of this project is from a value perspective? You could definitely go out, pay your own money to a third party valuation firm to get it valued. There's people that will do that, right? And there's online platforms that as well. But just be careful there that the syndicator is not going to say, "Hey, it's worth 6 million," right? They could probably give you an estimate, but if anyone's followed what happened in New York with Trump, real estate valuations are subjective. The real estate syndicator, the project owner, is always going to tell you it's higher than it probably actually is. The debt holder is going to tell you lower than it is, probably somewhere in the middle. So be careful of that. I would not buy a real estate token on the private market without having a valuation done unless I really, really understood that market where the projects were. Um, Okay, the last thing here, right? So remember though, if you do sell that token out, you're going to have a taxable gain. That taxable gain is going to be over your adjusted basis. So not your initial basis, but your adjusted basis. So basis less any losses, less any distributions, it's going to be a lower number probably. So if you got into 50, your adjusted basis and your tax return says 30,000, you sell it 100, you have a $70,000 gain. In addition to that, you need to break that gain down into capital gain and recapture ordinary income gain as well. So you got to be cognizant of this stuff. And I worry a little bit about people just willy nilly flipping tokens on the open market and not understanding it's not just like you're selling Bitcoin or something, or just a typical crypto element, because there's multiple aspects from a tax perspective you have to consider here, including the division of ordinary income and capital gain income on that exit. So just some considerations there to think about.